the elephant in the room surely is the gas market dependency that we have.
Absolutely. It's been interesting, like putting out this quite provocative op-ed in Energy Flux and sharing it on social media and seeing the feedback coming back from people. I mean, there's like an army of folks who would just say it cannot be done. Like you're barking up the wrong tree. The market's liberalized. You can't do anything about it. There's no way. There is merit in all of those arguments. If you start from the basis of like governments have no power, the market is omnipotent, and nothing will ever change. But it's like the broader context, the geopolitical context in which we're having this conversation is like, well, everything's changing. Look at the way that the Trump administration is wielding its enormous institutional power to push US LNG into Southern and Eastern Europe. It wouldn't be happening without that political push.
Hello, I'm Bryony Worthington, and this is Cleaning Up. My guest this week is Seb Kennedy, a journalist who takes a keen interest in energy, especially gas markets, and the founder of Energy Flux, his own media outlet. Seb and I, together with my colleague Harry Benham, recently collaborated on an article about the UK's relationship with Norway, which is dominated by trade in natural gas. I was curious whether something could be done to reduce pressure on UK customer bills, and given that we're living through some pretty extraordinary times, whether a new relationship could be forged that saw us playing closer to the actual supply costs rather than volatile market prices. Since the time of Margaret Thatcher, the UK's mantra when it comes to energy has been to leave it to private markets. But as we have tried to balance affordability with energy security and environmental protections, successive governments have introduced layer upon layer of regulations in our electricity markets. Gas markets, however, remain relatively untouched. And despite the fact that dedicated pipelines deliver most of our gas, prices have been pegged to international markets, inflating costs to consumers. We've used taxes to try to rein in the massive windfalls as market prices surged, but they can't be applied to imported gas. Norway is our most significant supplier, and their gas is cheap to produce, and the market is largely state-owned. They took the pipelines into national ownership recently and own a controlling stake at Equinor, the largest company. So the majority of windfalls we've paid on imports have ended up in the Norwegian treasury. In the article, which is published on Energy Flux, we discussed why, given market prices are set to reduce, it is now in both countries' interest to sit down to negotiate a closer relationship. The new bilateral deal we described centres around more long-term gas contracting between the two countries at rates closer to the cost of production, coupled with more de-risked investment opportunities for the massive Norwegian sovereign wealth fund in energy security infrastructure, including gas storage and electrification. My conversation with Seb starts with an overview of the global gas market before we get into the details of the article, and then end by briefly discussing the level of speculative trading there is now in global energy commodity markets. Neither of us would describe ourselves as anti-market, but there are some things like food and energy which are so essential to human well-being that all governments need to pay extremely close attention to prevent excessive rent-taking. We hope you enjoy the conversation. Seb, thank you so much for joining us on Cleaning Up. I wanted to kick off, as we always do, by asking you to introduce yourself in your own words, please.
Thanks for having me on the podcast, Bryony, and also thanks for taking the time to write such an interesting op-ed in Energy Flux, which I'm looking forward to discussing with you. So I'm Seb Kennedy. I'm an energy journalist and analyst and a publisher of Energy Flux, which is an independent news and analysis platform focused on the natural gas and LNG markets.
Thank you. And we should just explain your wonderful background, because you're not based, well, you're based in Costa Rica, right?
Well, I kind of have one foot here and one foot back in the UK. So I spend as much time as possible running away from winter.
Very good, very good. And I'm here in California doing similarly. So this is a conversation we're going to have about gas. And just to put this in context, clearly we're all about cleaning up, making sure that we make the clean energy transition. But by and large, if you look at how we've had big savings in Europe and the UK in emissions so far, a lot of it's been a switch from coal to gas. And we are still now pretty highly dependent on gas as a commodity, globally, as well as in Europe and the UK. So I just wanted to, from your perspective, can you give us a bit of a snapshot as to what's going on in the gas market globally? How much of an important factor is it at the moment in our energy mix?
Yeah, so globally, the gas market is really quite fascinating. It's been through a real roller coaster in the last sort of 5 years or so. I mean, obviously going back to like COVID, then we saw massive demand destruction and prices crashed. And then we kind of whiplashed out of that into the kind of post-COVID recovery. There was a lot of demand, supply couldn't keep up, prices went really high. And then to top it all off, Russia invaded Ukraine. And we saw this absolutely stratospheric pricing of natural gas, unlike anything that anybody had ever seen before for natural gas in Europe and by extension the UK. And that stratospheric pricing triggered a huge amount of demand destruction. So demand cratered because people were literally just turning down their thermostats, and industrial facilities in Europe and elsewhere were shuttering because the cost of running on gas was just too expensive. Since then, we've had a significant correction, as is always the way with these extreme situations. The prices have eased off over the subsequent years, and then they rebounded last year. We had this kind of incongruous rally again, where prices sort of increased nearly 50, 60, 70% in a few months, and then another big sell-off at the start of this year, because what we've got coming and what the market is struggling to price in is the next big structural change. As if all what's happened isn't enough, we've now got this unprecedented new wave of supply of liquefied natural gas, which obviously is those big cryogenic vessels that sail across the Atlantic, carrying liquefied shale gas from the US and from other producers. And the amount of new supply and production that's going to enter the market between now and sort of 2029, 2030 is like a kind of 50% increase in like LNG supply. And there are big questions everyone's asking is, where's all the gas going to go? And in order to absorb all that gas, then prices need to come down to stimulate new demand. So there's this question about, well, how low will prices go now between now and the end of the decade? That's the big question. And that's kind of at the heart of the question we've been asking about, well, what about the UK? How reliant is it on imports, and how is it positioned to kind of benefit or not from these structural changes?
And so there's two things going on, there has been two things going on at the same time. There's been this destabilization caused by Russia, who were one of the largest suppliers of gas, certainly to Europe. So that's caused price spikes. But that's then led to the demand destruction, where people are looking for alternatives. But then also we've got a kind of structural desire to move away from fossil fuels, which is, Europe, has got set itself some quite challenging targets. Lots of countries are now setting themselves targets to transition away from fossil fuels. And so that's also contributing to demand destruction. So how much of this coming glut is increase in supply versus these sort of more structural, we want to get away from this dependency, this kind of addiction to a fuel that we have to keep purchasing repeatedly, and the price volatility being a vulnerability for countries? Is it just both coming together at the same time?
It is, but what's interesting is that the gas industry itself is always quite slow to acknowledge the big changes, and the kind of mantra has always been, oh, there's not going to be a glut. Demand always rises, the market fixes itself. The best solution for low prices is low prices. More and more you're seeing oil and gas executives acknowledging that, yes, okay, like there is this kind of structural oversupply problem, but we think the glut won't be too big. And then you kind of got voices coming and saying, no, actually, it could be quite big and it could extend into the 2030s. We don't really know. And then the next thing, which they'll have to acknowledge, is the demand destruction side that you've just mentioned. So they've taken some time to acknowledge the kind of oversupply structural issue, which they themselves have created, the market has created. And then in the background, you have things like electrification, driving down critical end use applications of gas. I'll give you a couple of examples. One is in China, where actually a huge amount of the liquefied natural gas that China imports is used in heavy-duty trucking. They have an enormous fleet of LNG-powered trucks, but the sales on electric trucks is just going absolutely parabolic. They're electrifying their trucking fleet much quicker than anybody anticipated. So the idea that that will provide a kind of a demand growth segment in China is potentially open to question. Even if prices become very low, if they can electrify, then they will. And look at Pakistan. Pakistan has installed they've had a solar revolution in Pakistan. Just people putting solar PV on their roofs because the grid is so unreliable. And I think I saw a statistic that said that around about the entire capacity of natural gas-fired power stations in Pakistan has just been installed in solar PV capacity in the last year or so. So you can imagine what that's doing to baseload demand for power, much of which comes from gas. They've got a kind of backup of gas in the system. They've got too much. They've got nowhere to burn it because the power generation systems aren't running as much because all this PV is on the system, and they're actually having to turn away cargoes of liquefied natural gas that they've contracted to buy from Qatar. And that's very expensive because they're on the hook to pay for these cargoes, whether they take them or not. So there's a kind of financial cost to being exposed to being long on LNG when you have demand destruction eroding your LNG demand base.
This shift, I mean, it's driven by the sort of economics of the alternative, right? That it is now just quicker and cheaper to put in solar plus batteries if you want to kind of diversify away. And it sort of strikes me that that's kind of unstoppable now. And weirdly, if you look at the way the US has come in hard against climate measures, it may have a really counterproductive effect because, climate measures have actually driven demand for gas, quite a lot of it. And if you think Indonesia, China, large parts of India, they've got a lot of coal. And the only reason they would shift off coal is if they cared about the environment, right? And so if you come in and halt all climate activity because you don't believe it and you think it's a hoax, you might be killing off the demand for your product. Is anyone talking about that paradox that the US is maybe killing off its own markets by being such a skeptic on climate?
It's an interesting theory. I think it depends on the energy system of each country. So the reason that countries like Indonesia don't want to turn away from coal very quickly, the main reason is because it's energy security. They have the coal in the ground. If you rely on a commodity that is traded globally and in vessels that can be rediverted depending on where they can get the most profit, then it's not the most energy secure option to base your economy on. It's a bit of a luxury, and you don't have the security that you might otherwise have from things like homegrown sources being coal, or for that matter wind or solar. So in markets where gas is abundant, then it's a different question, right? In the US, then they're very much leaning on the gas sector to power the next stage of their economic development, and much of that being the energization of huge data centers to power these big AI machines and LLM systems, which are incredibly power hungry. They want the natural gas sector to do the heavy lifting on that. And that raises all sorts of problems because at the same time, they want to export, quote unquote, cheap US LNG around the world. But at the same time, they're putting a huge amount of demand onto their domestic supply base, which is inevitably going to increase the domestic cost. And that cost gets passed through into the buyers of LNG on the other side of the world. So you're into this place where, well, how competitive can LNG really be if you have demand destruction in importing nations combined with rising costs for the gas that gets put into these liquefied natural gas liquefaction plants to turn it into LNG to sell to places like Asia and Europe.
And I'm fascinated by this kind of unintended consequences of the US current approach to, well, everything really. Yeah, diplomacy, energy, it all seems quite chaotic. And because the other, we're talking here about LNG, they just, most of our listeners are very aware of this, but to take LNG to market is a lot more expensive than to push gas through an existing pipeline. So it's and why did the market think LNG is the future? Because we had this big disruption of Russian pipeline gas no longer being acceptable. But then what happens is China says, oh, well, hang on, we've got a neighboring border with Russia. We'll start taking the Russian gas from you. So again, that reduces a demand that could have been met by US supplies because of this kind of US first, US against the world position means that other alliances are being formed that are really unhelpful to the US. So I just think it's perhaps not been very well thought through, or at least it seems to be playing out that this move to use gas as diplomacy isn't really panning out as they expected. Or maybe I'm just reading the tea leaves wrongly here, and perhaps they just will prevail. But it feels like for most countries it's going to be quite a difficult thing to think, oh yeah, sure, of course we want more reliance on the US, just at the point when the US is indicating that it's America first and America only.
Well, you mentioned China in that context, and let's not forget there's a trade war between the US and China, and one of the reciprocal measures that Beijing has implemented is a tariff on US liquefied natural gas. So China hasn't imported a single cargo of American LNG for a year or so now. But yeah, it's like this idea of using LNG for diplomacy's measures, and then also trying to kind of start a trade war when you're exposed as a seller, you're reliant on them as like one of the biggest buyers of LNG. Yeah, it's not particularly well thought through. The market is kind of able to sort of hide the worst effects of this, but next year you have some very big supply contracts between US LNG plants and Chinese off-takers that will come into effect, and if they can't literally import them into their home market, then you're going to see that kind of oversupply in the Atlantic basin being just that little bit bigger than it might otherwise have been, because China could have absorbed those cargoes, but it won't. Now in Europe, it's different because there's been this almighty lobbying push by the Trump administration to sell US LNG into parts of Europe that were and still are to an extent reliant on Russian gas. And we've seen this absolutely phenomenal display of diplomats and ministers and high level CEOs from US LNG and gas companies going over to like Southern Europe, Eastern Europe, and trying to open up new import routes for liquefied natural gas towards Ukraine. So through Greece, there's like a pipeline network. They're trying to feed the gas up from Greece into Bulgaria and then onwards through Romania and to Moldova and Ukraine. And also from the north, so from like Lithuania and Poland down through those countries towards Ukraine, because Ukraine is obviously extremely short of gas, having suffered so much aerial bombardment of its energy infrastructure, and they urgently need to get that gas into Ukraine. I'd say that they're actually kind of being more successful on that front, because Ukraine just imported its first cargo of US LNG just this last week. A private company called DTEC imported a cargo from Louisiana, and I think it docked in a terminal in Lithuania, and it offloaded that gas. It's going to wind its way through the network into Ukraine, and I think they're knocking on an open door there, because the proposal to ban all Russian oil and gas from Europe by 2027, and the losses that we already had from the end of transits through Ukraine already are creating this kind of big demand hole in sort of Central, Eastern and parts of Southern Europe. And so, having an abundant supply of liquefied natural gas from the US, which is nominally an ally of this region, makes more sense. And so you've seen energy ministers and the transmission system operators all kind of queuing up to enable that to happen by lowering tariffs for the import of LNG and through those routes, and facilitating logistically the ability to kind of get the liquefied natural gas from places like Alexandroupolis in Greece into the pipeline system and pump it north towards those countries. And I think you'll see that trend increasing over time.
But also kind of geographically, surely it's much easier to bring in gas from the Middle East to that region. And are they not competing against much cheaper per unit production from, say, Qatar or other nearer vendors?
Yeah, I'm glad you mentioned Qatar, because that's really the elephant in the room for the whole LNG outlook. Not many people talk about Qatar, but you're right, they have the lowest cost of production of any LNG supplier. No matter how prices go, they will be profitable. So if prices on like market prices in Europe and Asia fall to a point where liquefied natural gas plants in the United States have to shut down because they're not profitable, Qatar will still be making money. So there's a big question, and they're massively increasing their production capacity over the same period between now and 2030. So there's this question about how does Qatar manage this advantageous position it finds itself in? Is it going for market share? Is it going to flood the market and essentially try to price the US shale LNG supply out of the market? Or are they going to just maximize revenue and withhold production and try to kind of maximize the margins on the molecules they are putting into the markets? It'll be very interesting to watch. Like Qatar is a big factor in this, but the problem they have in terms of getting to Europe is that they can't get their cargoes up through the Suez Canal because there have been a lot of hijackings and there's a lot of insecurity in the Red Sea. So liquefied natural gas vessels have been going the long way around. They've been going down around the southern tip of Africa, around the Cape of Good Hope, and all the way up the other side along the west coast of Africa in order to get to Europe. And that adds a lot of expense and time and logistical constraints to do that kind of long trip. So increasingly what we're seeing as a result of that issue, we're seeing LNG kind of slightly fragmenting. The market's fragmenting, where Qatar is facing east and focusing on China. And, China is turning its back on America, and America is kind of focusing on transatlantic trade and just supplying into Europe. So you're seeing this kind of, not really a fragmentation, but certainly like a bifurcation of the liquefied natural gas markets. And I think you'll see that manifest in different pricing regimes for LNG on the water in the Atlantic compared to in parts of Asia.
Returning back to the US, I mean, one thing that strikes me that Qatar has as an advantage over the US is that Qatar's domestic market and its population is tiny. So they can keep exporting. I'm sure their actual physical demand for their own country is a fraction of what they export. Whereas in the US, you've got a very large domestic market. So every increment more export that you add to the system, you're pushing up prices for your domestic market. And I just think it wasn't so long ago where there was a ban on exporting gas from the US, but precisely to keep prices low at home and to keep a handle on inflationary pressures on cost of living. And here we have that kind of completely ripped up, it seems, and it's just export as much as you can, but that's going to have an effect domestically, isn't it? And that's going to cause some political problems, I'd have thought.
Yeah, and I've flagged this in Energy Flux on numerous occasions. There are political repercussions that come when domestic energy prices go really, really high. And the US electorate is nothing if not accustomed to having cheap energy. They've had this shale bonanza. It's kept like gasoline, petrol prices cheap at the pump. Whenever gasoline goes above $5, there, like stickers start appearing on the refilling tanks and saying, during Biden, it was like, Biden, I did this. They're trying to pin the blame politically on Biden for making gasoline expensive. I think, you're going to see something similar happen in natural gas, because gas is obviously I think it's about 30% of electricity generation, depending on which part of the United States you're in, but it's like a humongous supply portion of power generation. And so if that marginal cost generator goes up from, the traded price on the Henry Hub is like $3-4, if it pushes up towards like 5 or 6, then that gets translated through to power prices, and people are really going to feel it. And that won't go unnoticed. There will be a response if it goes structurally higher for significantly longer than anyone's anticipating. Then yeah, I think you could see some repercussions, and it could happen in the next sort of couple of years, and it could coincide with the next presidential election, obviously in 2028. It's not beyond the realm of possibility that we see domestic natural gas pricing in the US get really expensive at exactly the time that it gets much cheaper in importing regions such as Europe and the UK, and of course the UK has we're going to have a general election in probably 2028, 2029 as well. So there's like an interesting political dynamic around this kind of equalization of prices, or the kind of narrowing of the spread between like cheap US and expensive EU gas and electricity prices coinciding with elections on both sides of the Atlantic, that, when people feel worse or better off, it can influence how they vote. So there is this enormous political dimension to the price of energy, and it's all like predicated on the cost of gas, which is influenced by all the things I've explained.
I think those political pressures are already coming to bear. There was a gubernatorial election that we just had in November, where a candidate won on the basis of basically saying, "I'm going to cap." This is the New Jersey governor. "I'm going to cap utility prices because the cost of living and affordability now is the big battleground. And we've got the midterms coming up, where I think energy prices are going to be a big feature. But so let's just talk though about the plus side, the upside of gas prices softening, because the theory is, right, that this big overcapacity has been unwittingly kind of unleashed by private actors seeking to kind of gain as much market share as possible, leading to this perhaps oversupply. And now that could mean prices softening. That's kind of problematic for the electricity transition. Just thinking about the spark spread that we have to if you want to see electrification as your answer to climate change, which a lot of people are now realizing that let's get off the molecules, let's stop burning stuff and let's electrify. But for electrification to make sense, you've got to have relatively cheap electricity and expensive gas. The spark spread has to be within reach. And at the moment, certainly in the UK, the spark spread is so high. I mean, it's over 4 times per unit, right? So for your heat pump to make sense, you've got to really see gas prices higher and electricity prices lower. But it looks like the opposite's going to happen, right? We're going to have probably higher electricity prices and now lower gas prices. So that really kind of challenges this electrification narrative, doesn't it?
It does. It's a real double-edged sword, cheap gas in a decarbonizing economy for the reasons you say. And one of the problems is that, while gas is the marginal generator in it, when it gets cheaper, electricity becomes cheaper. The reality is that for a whole host of reasons, power prices are not going to come down massively, and it won't be like one-for-one proportionate to the reduction in the gas price that you see on kind of wholesale traded markets. And that's a problem. So, I mean, I'm not really an expert in that field, but I've always thought that it's just madness to put all of the levies onto the electricity portion of the retail bill and to give gas a free ride. Like, if you're trying to incentivize electrification, put as many of those social and environmental levies onto gas or onto taxation or anywhere else, and keep the electricity as cheap as possible. And then you're going to see more people using heat pumps. You're going to see more people using electric vehicles. And then you're kind of reducing the demand base on your gas call, your gas demand. And that's only for a country that's exposed to import dependency, that improves your energy security. So I just see it's a bit of a no-brainer. There must be a reason why it hasn't happened until now, and it's probably because the departments can't agree. Nobody can agree when you want to heap some more cost onto my department, or just the kind of, I don't know, institutional inertia around getting things done could be a reason why this hasn't happened. But I think there's a bit of more movement in that space, if I'm not wrong, like people thinking about it anyway.
Certainly people are thinking about it. And I think it, the problem is we've got in our very immediate memory, we've got that massive spike that we had as a result of the illegal invasion of Russia into Ukraine, which saw gas prices triple pretty much overnight. The wholesale prices just spiked extraordinarily. And so the idea of making gas, this is gas for heating now, gas for keeping us warm in winter, and the idea of loading more costs onto that, it's just socially and politically sensitive, right? Because this is how people keep keep themselves warm in winter, and so so there's been this kind of desire to not put any more prices on. But if we're entering into an era of softer prices, maybe then we do have the courage to say, actually, now our focus has got to be making electricity affordable. And so that could see a rebalancing of the levies and the tax base to internalize the cost of gas. I mean, and the other factor is, if you look at what Europe's up to, they're about to extend their carbon pricing regime beyond power into gas and transport. So electricity trading system 2 is about to come into force, which will see carbon prices being added to those bits of the economy that have not currently been paying any real internalization of climate costs. That's about to start. So again, that changes the dynamic of electrification, hopefully in favor of more of it, but a lot depends on how that's implemented.
If ever there was a time to do it, it's now, because we're going to have structurally cheaper gas for the next sort of 5 years or so. So you have a little bit of leeway to do things like carbon pricing, to do things like putting levies on the gas portion of bills, because there'll be a little bit more headroom for that.
Cleaning Up is supported by its leadership circle. The members are Actis, Alcazar Energy, Arup, Signum Capital, Davidson Kempner, Ecopragma Capital, EDP of Portugal, Euroelectric, the Gilardini Foundation, KKR, National Grid, Octopus Energy, Quadrature Climate Foundation, SDCL, and Wärtsilä. For more information on the Leadership Circle, please visit cleaningup.live. If you've enjoyed this episode, please hit like, leave a comment, and also recommend it to friends, family, colleagues, and absolutely everyone. To browse the archive of over 200 past episodes, and also to subscribe to our free newsletter, visit cleaningup.live. That's cleaningup.live.
So we should have said at the beginning, actually, how we met, which was I'd been sort of musing about this relationship that we have with Norway, and we can come into why Norway matters so much. And I'd said to my friend Laurent Segelin, from the Redefining Energy podcast, who can I talk to about gas pricing and gas markets? And he said, "Oh, you need to talk to Seb Kennedy." So that's how the introduction came about. So we just published an op-ed on your site, and it was a collaboration between myself, colleague Harry Benham, and you. And we did a deep dive on Norway, but just tell us why Norway matters so much.
Yeah, so Norway provides about half of the natural gas that's consumed in the UK. It's produced in the Norwegian North Sea and other parts of the continental shelf of Norway, and it's gathered up through a network of pipelines and exported to the UK. They also have pipelines going to other countries, such as Germany and most recently Poland. But they're a major, probably the single largest source of natural gas for the UK. Of course, it never used to be that way. We had our own North Sea bonanza, but most of the resource has been used up, and production is on this kind of secular decline trajectory now. And it's, no matter how much investment you put in, it's never quite going to get back anywhere near to the glory days of the 1990s, when we were self-sufficient in gas and could even export to the rest of Europe. So like the UK has huge import dependency. A lot of that falls onto Norway. And of course, they didn't do what the UK did, which is they didn't completely privatize their upstream sector. They kept state involvement in their state oil company, Equinor, whereas the UK didn't. It was all privatized, and a lot of the benefits of the North Sea bonanza were essentially kind of frittered off in shareholder returns. And there was nothing really left for the states. Whereas you look at Norway, they have this sovereign wealth fund, and I probably should have checked the figures for how big it is, but it's like, I think is it in the trillions now?
Yeah, it's over $1 trillion. Yeah.
So they're kind of swimming in cash. But I guess the other element is it's not always a fair comparison, because obviously Norway has, a tiny fraction of the gas demand that the UK does, because they have such a small population. Plus, they're endowed with enormous hydro resources, so they don't really need to burn gas. So their gas demand is just like a tiny, tiny fraction of their overall resource base. So they have to export it. They are as reliant on the importing markets as the UK is on the exporting market. So there's this energy interdependency, and it's very closely intertwined. Going back decades now of this codependence between the UK and Norway. But the issue which you flagged to me, which I hadn't given much thought to, which has really got me thinking over the last week or so, is that, there's this codependency, but the vast majority of the gas which the UK imports from Norway is sold at market rates. And so Norway has just enjoyed the most phenomenal windfall rents on the back of market pricing for gas, which they produce right next to a friendly neighbor. And it should be added, they have some of the cheapest gas in the world too. We talked about Qatar earlier. They've got cost production, which is, depending on the field, perhaps even lower than Qatar. Difference being they don't really export it as LNG. They export nearly all their gas via pipeline. So they're constrained to where they can send it, but they have expanded their destinations to like all across northwest Europe, and as far as Poland now. But still, like they need people to buy their gas as much as the UK needs to buy it from them. And so you came to me with this kind of, from the political perspective, saying, well, shouldn't there be a kind of conversation about, like, is this a sustainable situation, as much for Norway as the UK? Because if they kind of keep selling their gas at market rates, then they're going to see an enormous revenue hit when the LNG wave depresses hub pricing for wholesale gas that they sell. And we ran some numbers, didn't we? And very rough calculation, the estimate is that Norway, or Equinor, I should say, Equinor specifically, they earn about 10-ish billion euros a year on their gas exports just to the UK. And like right now, the futures markets are pricing in a 30% decline in hub pricing. So that means like a 3 billion euro hit. I think it could go much lower than that. Many other people think it could as well. Goldman Sachs this week said that TTF, that's the main traded price of gas in Europe, could go down to $4 per MMBTU, which is 60% lower than it is now. So Equinor, 10 billion euros minus 60%, you do the math, that's the amount of revenue they could be losing every single year. So is there an incentive maybe for them to like strike a new deal with one of their biggest partners who could do with like kind of long-term visibility over their supply sources, and Norway in return would get long-term kind of demand certainty for their core export product?
You covered a lot there, and it's so for me, the thing that really struck me was that this point you made that Norway's gas is amongst the cheapest to produce in the world, right? And it's kind of tethered to us via pipelines, which is also the cheapest way to deliver gas. So you would expect then that geographic arrangement to pass through to us having a reasonably priced gas wholesale price, but it's not how it works. How it works is that Norway prices their gas according to market value, which is highly volatile, which we saw with the Ukraine invasion, massive spiking. And so because we're kind of geographically tethered, it's kind of a monopolistic arrangement, but they can just set the price according to the market, and it's not regulated. There's no form of price regulation that says, oh, hang on, that's a bit too high a profit. You're in excess of 40%, 50% profit here at the expense of the UK consumer. There's no way of sort of really stopping that from happening, except for signing contracts, long-term contracts that try and give you a price corridor. And I was just really surprised by it, but that's not how the majority works of the market. It's still being priced on the spot. You're paying merchant prices for a big portion of that, which when prices are low is fine, but when prices are high, you're really suffering. So, there's been an enormous amount of rent taking by Norway from the UK over the last, let's say, 5 years. And that's now sitting in their sovereign wealth fund. And we are, as a country, desperate for inward investment to get our economy kick-started, still exposed to high cost of living because prices being still relatively high at the moment. So now is not the moment to be having a big conversation with Norway about what can be done differently that benefits us both. And from the politics perspective, both are left-leaning centrist governments, both facing attacks from the far right on cost of living basis, and politically it would seem to me a deal with Oslo that kind of dampens down this, gets us onto a more even footing, and acknowledges that interdependency that you said. Norway needs us just as much as we need Norway, and we basically geographically share the same basin. It's just an accident of where the line was drawn and a timing. We exploited our fields a lot faster and earlier than they did, so they've still got a lot left, whereas ours is more or less done. This feels like a conversation you should be having, and I was trying to find evidence of high level conversations between the UK and Norway on energy, and actually the things they talk about are, it seems, I'm not in the room, so I don't know, but what's reported out is, oh, we had a conversation about CCS, or oh, we had a conversation about offshore wind, or we had a conversation about hydrogen, all of which are important. But that's the elephant in the room, surely, is the gas market dependency that we have.
Absolutely. And it's been interesting, like putting out this quite provocative op-ed in Energy Flux and sharing it on social media and seeing the feedback coming back from people. I mean, there's like an army of folks who would just say it cannot be done. Like you're barking up the wrong tree. The market's liberalized. You can't do anything about it. There's no way. And there's an element of truth in that. Like gas deals are struck by companies, not governments. It's like why should Norway give up its windfall rents? It's a free market, blah blah blah. And there is merit in all of those arguments. If you start from the basis of like governments have no power, the market is omnipotent, and nothing will ever change. But it's like the broader context, the geopolitical context in which we're having this conversation is like, well, everything's changing. Look at the way that the Trump administration is wielding its enormous institutional power to push US LNG into southern and eastern Europe. It wouldn't be happening without that political push. So this idea that governments are powerless, I just kind of question that. I think that we need to have a bit more imagination around what's possible. And this idea that the ministers kind of stand back and say, oh, we can't do anything, it's just the market. It's like, well, that's not necessarily the case. You've seen the way that governments can influence markets in the last few years now more than ever.
A couple of things on that. One as well that I found quite shocking was the degree to which the Norwegian system is not open to the market, because Equinor, the biggest provider, I think is it something like 67% owned by the Norwegian government. So it's not the market. It's a sort of state-sponsored market in Norway's case. Plus, they just renationalized the pipelines. So that's now totally in government control, and then they take a 78% rent, tax on the revenues from these. So it's wrong to say the market is driving things in Norway. It's very much a state-driven question and intertwining. Now we, on the other hand, have just gone, yeah, sure, let everything be liberal, and we try to do price controls downstream, like we try to put price caps on the utilities and this to protect end consumers, but we've done nothing to try and control the upstream side and to think again about how could you regulate this differently, or how could you sign bilateral or have negotiated arrangements that focus on the real issues here that are driving affordability problems. And it comes back to gas prices, really. I mean, they drive the electricity prices up, and they keep our heating bills up and make our industries more expensive. So it's nothing more important than that. Certainly more important than messing around with miniature hydrogen discussions or promises of some CCS at some point, which haven't materialized and will only ever add costs. They won't save costs. So I felt like there's time for a reset, really.
It's interesting because like the gas market used to be all about bilateral trades, point-to-point long-term contracts. There never used to be like deep liquid traded hubs market pricing for gas. This is all like a relatively new phenomenon from like the last decade and a half or so. And it's been, thoroughly embraced by every single UK government. It's been embraced by the European Commission, by regulators across the continent, and of course in the States as well, where they've financialized a lot of their commodities too. And I guess like the experience of liberalization has been, increase in market efficiency and like lots of cost savings for consumers. So until Russia's invasion of Ukraine, then the kind of cumulative cost savings to consumers of buying gas on liberalized market basis was in the billions of euros. But all of those savings were wiped out the day that Russia invaded Ukraine, and prices went parabolic, and all of that pricing was passed straight down to the retail bill of all the consumers. And so you're kind of like, well, that's the reality of market pricing. You are exposed to the roller coaster of the market. And I'm not advocating for like a complete abolishment of the market. That's completely unrealistic. But I think just having the conversation is a really interesting time to have it, just because like there is just so much kind of uncertainty out there, and like, can we do things differently? Now, one of the arguments that came back at me that really stuck from sharing this op-ed was, we've been through the pain of Russia's invasion of Ukraine. We swallowed these high energy prices. We've had to subsidize bills. We had to shut our industry. We had to turn our thermostats down. Why don't we just sit back and enjoy the lower market pricing that is about to kind of wash over the market and just be happy? Because like, why should we turn our back on the cheap energy when it's just around the corner? And I guess it's like, it's a really good point, right? And the only thing I can really think about that is like, well, isn't that a good moment to negotiate a long-term deal, right? If we can kind of lock those prices in for longer, then we can, the next time the market goes crazy, we've kind of got a little bit of insulation around the edges that at least we've got this long-term contract that has a cap and a floor price, and we're not totally exposed to that, the next parabolic geopolitical event.
Obviously that is the argument, isn't it? Oh, but the sunny uplands are about to arrive, and we should just sit back and allow this volatility to dip. But the nature of volatility is it won't be long before it spikes again. There'll be a boom, a bust, and another cycle. And there's two other elements that I think we touched on in the article, which I found fascinating. One is, what about our storage capabilities? Because one of the reasons the UK is so exposed to the volatility is because we have to buy spot, and we don't have very much in the way of storage capacity. And famously, when we left it to the market, Centrica shut down Rough, which was our biggest gas storage facility, on the pretext that it just didn't make any money. Now you have to question and wonder, was it because you were making so much money on the trading side of the business with the volatility that the storage was actually, the arbitrage of the storage actually would have undercut that income? We just don't know, because this is all now in the private hands. And we do know that commodity markets make a lot of money from trading, right? That there's the reason why there are so many people involved in these markets now who are not buyers or sellers, they're just intermediaries, and they are trading on a daily basis on this volatility. So why did we not keep strategic storage on it so that we could protect ourselves? And you came up with some amazing numbers about how exposed we are, say, compared to Germany, where they've got, I don't know how many days worth of gas storage, and we've got how many days do we have? Less than a week, isn't it? So it's just kind of mad how exposed we are to not having storage.
The UK has about 3.2 billion cubic meters, or 19 days of supply of storage capacity. And you compare that to Germany, which has 25.6 billion cubic meters, or 119 days of supply. So obviously they're far more insulated from price shocks to the extent they can use the storage for that purpose. Now, the question we didn't attack in this article, because it was already very long, but one thing I've covered a lot in Energy Flux is the way that storage is used. And so you can either use it as a strategic facility, you can use it for the benefit of the consumers, or you can let the private sector manage it and essentially kind of arbitrage away the time spreads. So the idea of like building more storage capacity, it's like, well, what's it going to be used for? And if it's just to kind of for the private sector, if the private sector is going to be the one that finances it, they're going to want to be able to kind of play the market and arbitrage away all the time spreads. But they've already told us that that's the margins aren't good enough to be able to justify the capital investment in storage. That's why we don't have much storage in the UK, because it was just not very profitable or even loss making, because the spreads weren't big enough, and the margins you made from putting gas into storage and pulling it out later just weren't high enough to cover the cost of operation, the cost of finance, cost of construction, all that stuff. Essentially it was like, well, we better put our money somewhere where it gets used, where it's like put to better use. So again, you got this question about, well, is there a role for the state to get involved, de-risk the investment and manage the facility for the public goods? Why not have a kind of strategic gas store, seeing as we're so exposed to the market and we're so exposed to imports, and we're not going, no matter how much money you pour into the North Sea, we're not going to get back to a place where we have this kind of abundance, excess of gas. So that being the case, maybe we should have a strategic gas store, just kind of, a bit of resilience in the system to tide us over these moments when the markets go crazy and consumers are kind of on the hook.
That also led us down into realizing that instead of bringing more of Rough back online to store gas. What Centrica are currently doing is exploring whether they should convert it to a hydrogen store, which, it's just like, I was kind of to beg belief, and in fact, we are already converting one of our smaller stores in the UK to hydrogen in the hope that somehow that's going to be filled up with some cheap commodity. How that's going to happen, I have no idea. And so at a time when it seems as if we've sort of skipped over the bit in the middle of the transition where we're still relying on gas and we've got to make sure it's affordable for consumers. And we've gone straight to this kind of like, oh, hydrogen economy nirvana, which, it's a bit of a figment of a gas lobbyist's wet dream. It's not, I don't see this as the strategic priority for today. Right. If it turns out that there's tons of green hydrogen floating around, it's really cheap and we need storage, then let's think about it when that happens, not now, when we're potentially reducing our gas storage in favor of this commodity. It just felt like we're strangely in energy policy focused on the very, very near term and the very, very long term and missing the middle bit.
Yeah, absolutely. Let's just get real. UK gas demand is not going to fall anywhere near as fast as UK gas production. It's just there is this kind of yawning gap between supply and demand. And that's only going to be filled in by the amount of gas we can convince the market to send our way. And that means by, paying market prices, paying above, so we have the UK traded price, which is called the NBP, the National Balancing Point, that frequently trades above the TTF, which is the Title Transfer Facility in Europe. So if the prices are higher in the UK than they are in continental Europe, the gas flows towards the UK to draw gas out of continental Europe to meet British demand, or conversely to attract LNG cargoes that are free to go wherever they want. They follow the market, they follow the money. If the UK is offering the most profits, that's where the gas goes. We're going to be reliant on this dynamic for a long time, no matter how quickly we manage to decarbonize and electrify and all this business. It's still going to be this massive import dependency. I just think that there needs to be a little bit more thought given to this than it's okay, there's loads of LNG, we'll be fine. Because that was the answer of successive energy ministers in the UK, was like, whenever there was a question in Parliament, should we not have a conversation about gas storage? Then they were very relaxed, kind of just leaning on this kind of LNG argument. Well, we have these kind of just-in-time supply chains. LNG will always be there. We've got these loads of unused capacity to regasify the LNG, to dock the ships and regasify the LNG and get it into the UK grid. And, look what happens when the market tightens, when the market goes crazy. Everyone's in the same boat. They're all bidding up the price to try to convince the gas to pull the gas towards them. That's what we saw in 2022, 2023. I don't think it's a very kind of healthy place to be for an industrialized economy, to be that reliant on imports, on market pricing. There needs to be some sort of resilience built into the system. And I think the ideas we flagged in the article is just kind of opening the conversation about what are we going to do about this?
And just to return to Norway again, it's also the case that, as you mentioned, we did not build up a sovereign wealth fund. We did not put our tax revenues into a special capital accruing facility. We spent it on schools and hospitals and goodness knows what to, keep the lights, keep the country running. But Norway didn't do that. Norway's, as we talked about, like Qatar, very small population, massive. All of this geographic accident of gas is an export potential for them. And that through this period, they've accrued a huge amount of money into their sovereign wealth fund. And that sovereign wealth fund is getting to the size where, it owns 1% of everything, I think. We did a brilliant episode on this with the lady who runs the Norwegian investment strategy. And it seems to me that they've had a bit of a failure of imagination. They just buy 1% of equities of everything. Got a very small portion. They've now sort of said, we're going to invest in some strategic project-led, financing and debt. But what if we said to them, look, UK, we are a very, very good customer. We're a very, very investable economy. We need to make a transition. That transition is going to be electrification. And we want strategic gas reserves. Put some of your capital to work in our country and not fiddle around with little bits of gas, little bits of CCS infrastructure, but do the electrification investments with us. So that's the long-term vision for us. and then do this gas storage in the medium term, so that we're sort of tying ourselves into a bit of a medium term plan and addressing the real issues that we need to get to grips with, so that the consumer ultimately benefits. Norway gets to have ties in because Norway's gas is going to run out, right? That's the other thing. Our gas is already on a declining pathway, no matter how much money you put in. It won't be long before Norway's there, maybe 20 years behind us, perhaps, but it's not going to go on forever. So let's put in place this, now different terms of mutual investment, but on the longer term, which is through this electrification strategy. I feel like there needs to be a serious conversation about energy between these two countries. As we said, politically, they're very similar. They've got mutual interests. They're trying to fight back this kind of populist right-wing attacks. It seems like the right time because of the softening gas prices. Let's do it.
Yeah, well, hopefully we've sowed some seeds in the minds of people who are placed to do something about it. We'll see. Just a final word on the storage thing, and the sovereign wealth fund, is that we've seen essentially sovereign capital put into UK energy infrastructure in things like UK new build nuclear, like Sizewell C. A lot of that is sovereign capital when you trace it back. So the only way to leverage that is to massively de-risk the project. We have a model. There's the regulated asset-based model, which can be applied to big infrastructure projects, and that could make UK storage facilities like an investable asset for something like the Norwegian Sovereign Wealth Fund.
We spend a lot of our time and on that kind of transition to away from fossil fuels. But the reality is, at the moment, we are still highly dependent on them. We're about to enter into the winter. We're Britain in particular, famously cold and wet island that needs this to keep everyone, safe and to keep the economy running. And gas is a fascinating topic. I think it's been we've been guilty of skipping over it. And if we do focus on it and look at it, it is the biggest driver of our prices. Now, we could do other things, including, as we talked about just today, rebalancing the tax base away from electricity to keep that better. There's to keep that more affordable. We can change the way we price electricity as well. That's the other big sort of elephant in the room, is that gas is the price setter for everybody in the market. Therefore, renewables are actually on occasion getting big windfalls. Those of them that are outside the CFD mechanism, they're getting a lot of money in rents because of the gas setting the price. So there's lots that needs to be done. I feel like that's where our attention should be in the short to medium term, because the cost of living crisis may be softened by the market, but I'm skeptical that just hoping that happens is all that we can do. I'm sure there's more that we can do.
Yeah, hope is not a strategy.
Exactly. Well, listen, Seb, it's been a delight getting to know you and to working together on this article. Where can people find this article if they want to read it?
Yeah, go to www.energyflux.news. It's on the homepage at the moment. You'll see the UK Norway Gas Trade, time for a new deal, ? It's free to view. I'm on the regular social channels at Energy Flux or Energy Flux News.
And as we said, this is provoking. It's an intervention that's designed to provoke responses, and we've already had a few, as you said. There's also going to be questions raised about, well, if you're asking Norway to start doing this, what's the UK's approach to its own supplies? And that's a whole other subject about the fact that at least when it's our own North Sea production, we are taxing it. We tax it for windfall profits. We can't do that to the Norwegian supply. But maybe there's a better way even there. Why allow prices to be set at market rates and then claw back the tax? It seems a bit inefficient. Perhaps just get the pricing better. Could we not regulate that? So it should be hopefully a good stimulus for lots of people to come in and say why we're wrong, why it can never be done. But then for some people, maybe, well, perhaps we could reimagine it. Not that we want to mimic Trump and his way of working, but in a period where norms are being challenged all over the place, perhaps we should be challenging norms in favor of citizens and consumers getting a better deal, slightly less rent taking on this commodity market that is at least volatile. That seems to be its defining feature at the moment.
And like the structural changes I've described coming down the pipe of the gas market. I follow them with granular detail in Energy Flux. I put out regular chart decks and deep dives looking at how the economics of gas are changing. And as an independent publisher, I'm in a privileged position to say things that other gas analysts are perhaps kind of encouraged not to say in such a loud voice.
Oh, yeah. And which reminds me, actually, Seb, I wanted to mention the work you've done looking at quite apart from this, supplier demand interdependency, there is this middle tier of commodity traders who are in the market. And you've done some really interesting analysis because of some of the European transparency rules. We can now see how many trades are happening on these commodities. And it's an extraordinary number of actors that have come into this market, right? And hedge funds and different trading desks. And you've uncovered some of that, but that transparency isn't quite what you want it to be, is it? It's still in favor of this market mantra that, all trading is good trading. And there comes a point where I think some trading is entirely parasitic, and we're just seeing another source of rents being taken out, which is just straight into the city and into financial markets.
So this is another kind of heretical view that I like to give a little bit of oxygen to in Energy Flux, is just to kind of ask the question about the amount of speculation that happens in these financialized commodity markets. So yeah, just last week, the Commitment of Traders report, that's where the exchanges, they publish the overall net positions of all the different actors. It's all anonymized and aggregated into trader type. But basically, there are now 450 hedge funds actively holding TTF futures. That's risen, 5 or 6x since Russia's invasion of Ukraine, because there was such a massive money-making opportunity when prices went really high. For anybody that was holding a long paper position in gas futures, they made just immeasurable fortunes. Also, physical volumes were obviously, the rents on those were enormous. And so since then, you've seen this humongous wave of investment funds, hedge funds, piling into to TTF futures. They see it as a kind of very easily accessible, deeply liquid trading hub where they can come in, take positions, exit, and kind of repatriate profits back to their original source of their funds, which often tends to be like in the US or in Asia. You have kind of investment funds, hedge funds, high net worth individuals who are kind of basically kind of playing the markets. Now, the argument I always get criticized for this, because it's like, well, you can never have too much liquidity on a traded hub. Everyone always says, there's no such thing as too much speculation. When you want to get in and out of a contract, you need a liquid hub to do it. And the traders, they're all there. The hedge funds are all there as your willing counterparty to allow you to exit or enter a position quickly. I just think that nothing in extreme is healthy, and I don't think that argument holds up. Like, what if we have like 1,000 or 2,000 hedge funds, or 50,000? Is that still healthy? Like, I don't know the answer. I just ask the question, because what we saw on the traded price of gas last year was this almighty bull run in the price. Even after Ukraine and the prices have come down again, we saw like a kind of 50% increase in the traded price of gas on the basis of nothing very much, apart from that hedge funds have built up an absolutely humongous net long bullish position on the future price of gas. So I did some correlation analysis looking at this, and the relationship between the price of gas on the market hub and the change in the position of the traders is upwards of like 60-70%. So what I'm saying is that, like, when the hedge funds move their positions in TTF futures, it moves the price of gas, and TTF is the benchmark that moves the price of gas all over Europe, including the UK. It just doesn't seem to me that that they are all improving liquidity for the good of the consumer. They're all in it because they're extracting value from the system. And I just don't really buy the argument that if we were to kind of lose 50 or 80% of the hedge funds, that somehow the traded depth of the market would dry up and prices would go all volatile again. I think there are a lot of people they're just kind of trend following. It's like, you buy low, sell high, exits, take take the money back to Texas, and everybody's happy. That seems to be the way that the price is set on the TTF at the moment. But what's really interesting, I don't want to go on too much, but like, the hedge funds are all sold out of their positions. They're almost net short TTF because they can see the LNG wave coming. So that's like, they've all been kind of flushed out at the moment. So it'd be really interesting to see how that dynamic evolves as well, because they aren't holding long positions, but there are more of them involved in trading futures than ever before. So big question mark, what are the hedge funds going to do to the price over the next 5 years? We don't know.
You don't need to be a trading expert to realize that the presence of speculation in a market, yes, it's going to be extracting value out of a market and therefore adding cost to the end consumer, right? Because even if a lot of the losses, if a hedge fund is making money, it's presumably because a physical contractor is losing money, and that price cost to them, if they're losing, will be handed on in the commodity prices that they charge. So I feel like it's just it's parasitic in the sense that these are people in the market in buying and taking long and short positions, which is going, if they're making money, then that money's coming out of the system, and that's going to pass through into wholesale prices. Now, I'm sure we'll get people commenting saying, well, you fundamentally misunderstood this. But I remember meeting a very old bank, actually, interestingly, whose stated sustainability policies was they would not trade in food commodities. And it was just there, and it had kind of been there for hundreds of years. And I asked them, why is that? This was because it pushes up the price of food. And that's kind of immoral, really, because we need people to have more food, not less. And these want prices low. And so 500 years ago, they knew that speculation on commodities has a real world impact in a way that speculation on equities doesn't, or bond markets, because these are commodities that people need. And if you're pushing up those prices, it's morally questionable if that is actually okay. So I think there's just a very fundamental question about how we regulate trade in commodities. And I suspect one of the post-Brexit dividends we've got is that's completely unregulated now, and that Europe is itself still struggling with this because it's, capital can always put pressure on policymakers. Anyway, big philosophical discussion to end on there. I'm not doing it justice, but I think hopefully our listeners have, many of them are gas experts already, but if those who aren't, I hope we've kindled some interest in this market and how many dimensions are at play at the moment and how interesting it is. And Seb, I encourage everyone to follow your work on Energy Flux, where you can get the very, very interesting heretical views sometimes, but just detailed understanding of this market. So thank you.
My pleasure. Thanks so much for inviting me. It's been a pleasure getting to know you and working together.
So that was Seb Kennedy, journalist and founder of Energy Flux. As always, we put links in the show notes to relevant information, including the article we discussed, and to episode 138 with Corrine Smith from the Norwegian Sovereign Wealth Fund. My thanks as always to Oscar Boyd, our producer, to Jamie Oliver, our editor, and to the rest of the Cleaning Up team and the wonderful leadership circle who make these podcasts possible. And thanks to you for listening. Please join us at the same time next week for another episode of Cleaning Up.
Cleaning Up is supported by its leadership circle. The members are Actis, Alcazar Energy, Arup, Signum Capital, Davidson Kempner, Ecopragma Capital, EDP of Portugal, Eurelectric, the Gilardini Foundation, KKR, National Grid, Octopus Energy, Quadrature Climate Foundation, SDCL, and Wärtsilä. For more information on the Leadership Circle, please visit cleaningup.live. If you've enjoyed this episode, please hit like, leave a comment, and also recommend it to friends, family, colleagues, and absolutely everyone. To browse the archive of over 200 past episodes, and also to subscribe to our free newsletter, visit cleaningup.live. That's cleaningup.live.